makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie, stepping in for Francine. Here's what's coming up on today's programme. BOJ Governor Kazuo Ueda sees the possibility of a rate hike in July, depending on the data, and says the cut to bond buying may be substantial after delaying its decision. European stocks slip and the French bond rout is in focus. But over on Wall Street, the S&P 500 notches up yet another record high after PPI, producer prices, come in lower than expected. Plus, Joe Biden vows Ukraine's allies will stand with it until they prevail in the war with Russia and praises the latest G7 support plan. We are live on the ground in Italy with the latest. Let's check in on the markets then, and you are getting a divergent picture this week in terms of the performance of US markets. We've talked about that fourth consecutive record for the S&P, and the picture for Europe. Europe currently set to end the week lower. We'll see how it transpires in the session today, but you can see red on the screen once again. The French markets continue to be in focus as we got more details in terms of the political splits in France on the left and the right. The CAC aren't in focus, the banks and luxury under pressure on reports as well that some of the big French names exposed to China are having to cut their prices, and pretty significantly. So you can see the red on the screen there as we flip the board and look at what's happening in the currency space and reflect as well on the benchmark US 10-year, given another successful auction of 30-year debt Treasuries yesterday in the US, 22 billion, well absorbed by the markets, the highest bid to cover ratio that we've seen year to date, suggesting the market is able to absorb that issuance, and maybe investors as well wanting to lock in yields before those cuts come through with the Fed, with markets now expecting up to 48 basis points of cuts potentially from the Fed this year. S&P futures then currently pointing lower by just 0.1%, again with the context that you've seen 4 straight days of record highs, led as well, powered once again by IT and tech, with the likes of Broadcom, Tesla in focus. The 10-year then at 4.22, comfortably below that 4.30 level, a yield move just 1 basis point so far in the session. The Japanese yen down 0.4%, but pairing some of the heavier losses of the session after we heard from Ueda pointing to the possibility of July in terms of the next hike, and saying that the moves and adjustments around bond purchases will be significant. Euro-dollar, single currency, it's been a choppy week, of course, given the politics of France. 107, down 0.3%. Let's get the details then on what we've been hearing from the Japanese Bank of Japan Governor Kazuo Ueda, saying that rates could rise in July. He opened that door, depending on data, of course, and what comes through, what transpires between now and then. At a press conference, the central bank chief also said the size of a cut in bond purchases will be substantial. The yen then pairing some of its losses, as I mentioned, on the back of those comments from the BOJ governor. Let's get the context and bring in Bloomberg's Brian Fowler, who's been watching all of this for us out of Tokyo. Brian, where does this leave us then, in your estimation, in terms of what to expect from the BOJ over the next month? To what extent can we be assured that July is next for this BOJ?
Well, one thing is clear. July is going to be a very exciting meeting for us to watch. For one thing we know for sure, we're going to get the details on those plans to reduce bond buying. After that announcement came out today, of course, we saw the yen sell off, and I think there was a broad disappointment in this very vague decision to cut bond buying but not really talk about what we're going to do. And I think a lot of people thought that that might mean, well, there's consensus on the board to do it, but there's not any consensus on how much to do. Maybe they won't do much. So that was an important point in Ueda's press conference when he came out and said, well, I can't tell you exactly what the number is going to be, but it's going to be substantial. So that's important. The other question you alluded to, a lot of economists had expected in advance of today's meeting that the BOJ would hike rates in July. And then when we saw that they hadn't really gone all the way with the bond buy cut plan, you know, they were keeping those details waiting till next month. A lot of people thought, well, they probably can't do both of those big things in 1 month. So he was asked directly during the press conference, is it possible for you to do both things at one time? He was speaking very much in a kind of theoretical point of view, but he definitely said it is possible if economic conditions warrant it. It is possible, of course, for us to go ahead and hike rates in addition to disclosing our bond buying reduction plans.
Okay, interesting. Even though only phrased within that theoretical kind of framework, given his academic background, interesting that he was able to combine the two, at least in terms of that thought process. In terms of the yen, then, as we've been discussing, it's paired some of the heavier losses of the session, currently at 157.59. Is he under pressure, the Bank of Japan governor, to provide some support? Did you get a sense from the presser that that was part of the rationale for some of these details coming through?
Yeah, that's definitely the case. So, of course, 2 months ago, in the previous press conference, Ueda came out and he sounded very sanguine about the yen. He really didn't convey much urgency, and we subsequently saw the yen sell off to a 34-year low, and that, of course, prompted Japanese authorities to enter the market with the biggest ever currency intervention. So we know that Ueda was aware of that. He got scolded by the prime minister not too many days after that happened. So this time around, we were watching very closely to see how he would talk about currencies. And he didn't say a lot, but one thing he did say was that recent currency moves could definitely be seen as a potential factor that's pushing up inflation. That, of course, is a hint that, okay, I'm watching, and this could be one more reason to go ahead and hike interest rates sooner rather than later, and that we would expect to help support the yen if and when it happens.
OK, Brian Fowler, thank you very much indeed with the details and analysis out of Tokyo on the back of the press conference, of course, from the Bank of Japan governor and the decision, not unexpected, of course, to hold rates, but the details around the bond purchases and a potential additional hike coming through in July. Let's bring in Hugh Gimber at this point, Global Market Strategist at JPMorgan Asset Management. Hugh, welcome. Thanks for joining us in the studio this Friday. You've got your half-yearly outlook, and we'll get to that. But before we do, and you can tie this in, how much clarity do you think you come away with at the end of this week when it comes to central banks, given the adjustments around the dot plot from the Fed, some of the data suggesting that prices are cooling in the US, and then what we've been hearing from the BOJ?
Yeah, let's start with the BOJ first of all. I think it paints a very clear picture of the dilemma that they're facing here, which is that inflation has picked up. And for a long time, that's been exactly what the BOJ has been looking for. But now you're starting to see the wrong type of inflation. This is imported inflation due to currency weakness, and that's hurting consumer sentiment and ultimately hurting growth. So this is where the BOJ know they need to act to try and stabilise the currency, but at the same time, they don't want to go too far and cut off the recovery which is in train and squeeze interest payments as rates move higher. So they are stuck, quite frankly. The Ministry of Finance trying to intervene when the BOJ is buying lots of bonds. The two don't tie together. So I think what we're hearing from this morning is that they are waiting for the Fed to move, and it's really the US economy which needs to cool further in order to take some pressure off Japan.
Well, to that point, if the BOJ is stuck and looking to some extent, to a large extent, to what's happening to the Fed, is the Fed less hemmed in than it was at the start of the week, given the data that we've seen?
Yes, categorically. I think they've been waiting for several months for a softer inflation print. And finally, we've not just had one, but we've had two when you include the PPI data yesterday as well. Now, for me, the Fed meeting on Wednesday evening was an interesting one, because the headlines that came out were dot plots go from 3 cuts to 1 cut in 2024. But ultimately, in the dot plot, you've got a chunk of policymakers saying we think 2 cuts. You've got a slightly larger chunk saying 1 cut. And it's clear the Fed isn't totally sure about the path of inflation, and neither is the market. But one of the big themes in the outlook that we're talking about is that markets are comfortable, the next move is lower, and rightly so. That is what's anchoring risk assets here and providing investors with comfort to keep holding equity exposure, because the risk of a further hike through the lens that the Fed is viewing this data is still low. OK, so you fade the risk of a hike, and that, for now, is enough for these markets. You've got the AI play as well. Is there a fragility to the records that we're seeing across US stocks at this point, or is it well-founded? So the US growth rally has been anchored on very strong foundations, but we think when you look at some of the shifting economic momentum around the world, this is now the time to start thinking about fading some of that US strength and looking to other pockets of growth elsewhere. So take Europe as an example. A tricky week, obviously, in the context of politics, but you now have European consumers finding their feet, getting back spending, consumer confidence picking up as real wage growth turns positive at a time where US consumers are just showing some signs of fatigue. So I think we could well end the year with global economy sort of regionally in roughly a similar spot. But one of the big focuses for us at the moment is you've got Europe and the UK coming from a weaker base and seeing stronger momentum, and the US economy just now cooling off back towards trend-type levels of growth.
And you don't think the political uncertainty, whether it's here in the UK, arguably less pronounced, or in the Eurozone, is going to derail that shift and the proximity now as Europe catches up to some extent with the US? You still want to be adding exposure to European equities?
So there are two sides of that argument. The first on Europe is to think about what was not mentioned in the parliamentary election, right? No mention of exiting the EU, no mention of exiting the euro from all of the right-wing parties that 5-10 years ago would have had that as front and centre. So, yes, this is a tricky political time. Markets have said we'll sell first, we'll think second this week. But ultimately, this is a very different policy stance from the right-leaning parties than we've seen in the past. At the same time, don't forget US political risk. A 6% fiscal deficit is a key part behind the growth exceptionalism that we've had over the past 12, 18 months. You spoke about the bond demand being smooth this week and investors looking to take down yields at these levels. But let's just bear in mind, you've got both sides of the aisle talking about cutting taxes in the second half of this year as you see those tax cuts being continued and not allowed to roll off.
So what we're seeing in Europe could be a forewarning of the political risk in November out of the US, and then positioning around that notoriously difficult. What is your advice on that front?
Of course. So another core message for us at the moment is that while the US election has to reduce your confidence effectively in any big macro view, we still feel more comfortable owning duration risk in the UK and in Europe relative to the US, given the wider range of outcomes that we see around US Treasuries. This exorbitant privilege that people talk about for the US economy, right? They can get away with running higher levels of debt than any other economy in the world. But that being said, 420 on a US Treasury, to me, is not offering you that much compensation in the context of a bond market in the second half of this year that we think will start to pay more attention to the fiscal trajectory.
Can emerging markets, can EM outperform if China isn't that catalyst within that space?
I think that's harder, frankly. When we're looking for value around the world, the core theme of our outlook is finding value, avoiding traps. We find better value in Europe than we do in Asia at the moment. Japan facing difficulties, as we've described. China, I'd say the headline here is more policy support than expected versus the start of the year, but still not enough to get that economy onto a sustainably stronger growth path. And then you look at places like India, which, yes, they have the macro backdrop, but also now looking pretty expensive. So when you're looking for value within equity markets, we tend to focus more towards Europe today relative to Asia.
OK, Hugh Gimber, always smart. Thank you very much indeed. Global market strategist at JPMorgan Asset Management, making the case for Europe on a challenging week, of course, when it comes to the politics and the equity market story. And we'll see how that unfolds in the weeks and months ahead. Hugh, thank you very much indeed. Let's check in on one corporate story that is, again, benefiting from the AI embed. And that's Adobe, of course, provides all of these software tools within the creative space and coming out with details that suggest it is benefiting in terms of its forecast for growth from embedding some of those AI components into its software products and the uptake that they are seeing from customers. And that stock pre-market up 15%. Another winner in terms of the AI space, at least for now, for Adobe. We continue to keep across that story for you. There's plenty more. We'll get back to the geopolitics with Joe Biden. US President, of course, vowing that Ukraine's allies will stand with it until they prevail in that conflict with Russia. We've got the latest from the G7 summit next. This is Bloomberg. Welcome back. Happy Friday. Checking on one stock for you within the defence space, Rheinmetall, and that stock taking a hit, currently down 5.3%, as you can see. Details on this coming through in terms of their need for staffing and employment. Continental and Rheinmetall signing a letter of intent to cooperate in workforce recruitment, with Continental partly covering Rheinmetall's increasing need for personnel. So the concern seems to be coming through for investors that this is a company that, despite the demand, is still stressed by that need to get employees and staff into their businesses to help meet that demand. So the stock currently down 5.3%. We'll keep across that story for you. Partly linked, of course, to the geopolitics and what is transpiring over at the G7. Of course, that support, international support for Ukraine as the conflict continues. President Joe Biden vowing that the US and its allies will, quote, be with Ukraine until they prevail in this war. Leaders at the G7 summit agreeing to a breakthrough deal that will use profits generated by frozen Russian sovereign assets to provide an upfront loan to Ukraine. The $50 billion of fresh aid expected to start flowing to Kyiv by the end of this year.
Another reminder that to Putin, we're not backing down. In fact, we're standing together against this illegal aggression. The agreement that President Zelensky and I just signed also lays out our shared vision for a just peace, a peace rooted in the UN Charter and the principles of sovereignty and territorial integrity, a peace with a broad base of support around the world that holds Russia accountable for the damage it has done in this war. In 3 major steps at the G7 that collectively show Putin we cannot wait us out.
OK, for more, let's go to Bloomberg's Oliver Crook, who is in Italy covering this event for us. The G7 summit has been on the ground throughout, following all the twists and turns. Ollie, there is an agreement, but it may not be that simple. Talk us through the detail.
Yeah, Tom, so really it was very important for the G7 leaders to come here and really get something concrete, or at least apparently concrete, in terms of how to monetize those Russian assets. And so what that looks like is a front loan of $50 billion repaid in the future by the profits of those Russian assets. Now, there are a number of questions, though, technically speaking, that have not been resolved, and that, frankly, Tom, until they are, this money is not going to flow. One of them is, how do you insulate taxpayers of all of these countries from being on the hook? If these Russian assets at some point, say, thaw, who is going to pay those future payments on that? That is a very open question. The other question is, every 6 months, the EU needs to unanimously agree to continue to freeze those Russian assets. You have members of the EU, like Hungary, that are maybe a little bit more reticent to do that, right? And so these are all questions that still need to be resolved. So they keep saying that we need to work out the technical details. They'd like to disperse this money before the end of the year, but that hasn't been figured out yet. And Biden says, hey, listen, and so to the G7 leaders that are here now, we're going to be there till the bitter end. But they may not be there to the bitter end in terms of the fact that their mandates may expire. Biden is up for election later this year. We have all this sort of difficulty with a number of G7 countries. And you had all this sort of show of force. We had this sort of spectacular display yesterday of these parachutes coming down with sort of each of the G7 flags being streamed out. And then afterwards, we had press conferences from the leaders. I attended the one from Macron. You can imagine that the journalists were not particularly interested in what he had to say about G7 lofty global issues. The real questions for them was this sort of skydive of his political career and what that means for France and the kind of authority he has now on the global stage.
OK, Oliver Crook, fantastic work out in Italy covering the G7 for us. Ollie, thank you. Coming up, Tesla shareholders approve Elon Musk's $56 billion pay packet and his plans for a move to Texas. We bring you the details on that story, the implications for the company. That's next. This is Bloomberg. Welcome back. Now, Tesla investors have backed CEO Elon Musk's pay package. They've given it their approval and the moving of the company to Texas. The shareholder vote was seen as a referendum of degrees on Musk's leadership after, of course, slumping sales and a drop in the stock price. Musk spoke shortly after the result was announced, where he touted Tesla's AI capabilities.
And Tesla is also the leader in real-world AI. So there's really, this is a big deal. Like Tesla is ahead of Google, Meta, OpenAI, anyone on real-world software, actually taking in video and making decisions based on video. No one is even close. And it's getting better.
No one else is close in terms of real-world AI. That, the take from Elon Musk, of course, the CEO of Tesla. Let's bring in at this point Bloomberg's Craig Trudell. Our cards are, Craig, is he right?
You know, it was interesting listening back to that audio again because, you know, he name-checked Google and Meta during the meeting. He also, I think, you know, Airbnb, Uber, it was like any tech company.
who he's not particularly close with anymore.
All sorts of companies that he name-checked last night. In terms of, you know, the real-world AI, I mean, I do think it's fascinating because, you know, he pointed again to this robo-taxi model that he's been flogging for years now. It absolutely is the case that they have succeeded in selling people on the ideas and the concepts, but in terms of actual execution, he does not have a self-driving car to sell anybody at this.
Is he going to get his $58 billion?
He will not get his $56 billion package as a result of last night. I think, you know, what happens next here, he's going to, in all likelihood, appeal. He can't do that until a sort of procedural development happens in the next few weeks. Whether or not he's able to ever get this is going to be dependent on whether or not he can you know, steer this toward the Texas courts.
Okay, I upgraded his pay by $2 billion. Thank you for correcting me on that. $56 billion. Craig Trudell, thank you very much indeed on the take there in terms of the fortunes of Elon Musk and AI. Plenty more coming up. This is Bloomberg. Welcome back. Happy Friday. BOJ Governor Kazuo Ueda sees the possibility of a rate hike in July, depending on the data, and says the cut to bond buying may be substantial after delaying that decision. European stocks slip and the French bond focus rout is and remains in focus. But over on Wall Street, the S&P 500 notches up yet another record high. That's after producer prices came in lower than expected. Plus, Joe Biden vows Ukraine's allies will stand with it until they prevail in the war with Russia. He praises the latest G7 support plan in Italy. Good morning. Welcome to The Pulse. I'm Tom Mackenzie in London. And again, a very happy Friday to you all. Let's check in on Adobe because pre-market, the stock is getting a healthy bump on the back of its outlook and demand from customers. And it's the AI story at play for Adobe. We're getting more colour now in terms of how some of these companies are incorporating some of these AI products and services and the demand outlook, and they are expecting that to pick up. It's giving a lift to the shares, and again, it's another indicator that the AI theme has not run its course, at least not yet. Adobe getting a lift pre-market up close to 15%. Let's switch focus now to a broader space, tying into AI as well to some extent, the plumbing behind a lot of what's going on. Bullish investors are betting that the lucrative push by Goldman Group from industrial warehouses into data centres and AI has further to run. Shares in the Australia-based firm have raised more than 40%, rallied more than 40% this year, making it the top performer on Bloomberg's World Index of Real Estate Investment Trusts. My next guest is also confident about the play for digital infrastructure. Andrew Lee is TMT Group Head at Goldman Sachs Global Investment Research, with a focus particularly on the telcos space and possibly a turnaround there. Andrew, thanks for joining us. Happy Friday. Thanks for joining us in the studio. Let me just run through what's been happening with a few of the big names in this space. BT is up 9% year to date, but over a 5-year period, the stock is down 20%. Vodafone down 20% over 5 years. Telia down about 11% in the Nordics. You think there's a change happening, that this is a pivot moment for some of these telcos. Why?
Yes, so our stocks are having an exciting moment. They're starting to really ramp their growth and returns, and that follows almost 2 decades in the doldrums. What's basically happened is we've seen a deregulation in the fibre broadband space to try and incentivise investment, and this follows 2 decades of regulators only aiming about lowering consumer prices, over-regulating the sector and driving down the returns that telcos can make. That's led to underinvestment, it's led to no growth, and it's led to the telcos losing money and investors losing money. What changed is the regulators realised they need to try and incentivise investment for fibre. It was clear that the copper broadband network was not good enough, and they've done that. And what we're seeing now is the benefits of that. So telcos are starting to raise prices for higher speeds, drive their growth higher, and drive higher profits.
And they have the scope to raise those prices because margins have always been a question for these telcos. Heavy costs on the capex, squeezed in terms of the pricing. But that is trying to change, or that is starting to change.
What we've been left with after this heavy regulation is pricing across Europe in terms of broadband way below the US and Asia. And so the raising in pricing, even if it's 5 to 10%, is the equivalent of a cup of coffee. So there's consumer affordability and there's consumer demand. So when we look at incumbents roll out fibre, say in the UK, within 18 months of rolling out a fibre product past your home, you're 50% likely to take that product up for a higher price. People really want faster speeds.
Some of those products, though, are coming through alternative networks, backed by private equity. There's dozens of these that are taking place, building out cables and fibre here in the UK and elsewhere as well. Is that story still a challenge for the incumbents?
Yeah, it's a classic case of private investors having longer-term time horizons for their investments and backing this early. And so private altnet companies did roll out sooner and have had some success in that. And they had that success because they had cheap rates, so cheap financing, but also first-mover advantage. What that's done, along with this regulatory change, is really kick the incumbents to roll out fibre fast. And that's what's happening now. What that's doing is taking away the opportunity for the altnets. So we're starting to see those altnets struggle, and we think that's going to lead to a wave of consolidation in that space.
What does that consolidation look like, and how accretive could that be then?
So what it should lead to, what we think it will lead to across a number of markets, the UK, Germany, Netherlands, is it will cement a duopoly in those markets. That's a market structure that can support market returns and compares to what we see in the mobile space, which is a four-player market, commoditised and doesn't generate higher returns. So we think that this whole wave of consolidation will basically drive high visibility on returns for the future.
Where are we on cost savings? There's a focus in the note on it. It's an ugly word, frankly. Softwareization. Maybe you can say it better than I can, Andrew. But this is around cost savings, and this is around some upside in terms of the software capabilities of some of these telcos.
Yeah, so this is where AI comes into our sector. So telcos are really headcount dependent. They've been really dependent on customer services in the past, and they've started to replace that with AI, with mixed success. But the networks are really headcount dependent as well. And as we upgrade to fibre and as we upgrade to 5G, those networks need less headcount, but AI can help you identify problems and actually fix those problems without the need of an engineer. And by reducing headcount, that basically leads to high profits.
Do you expect that reduction in headcount to continue for some of these big names? Because they've already cut. Some of the big names have already cut thousands of workers. Does that trend continue for them?
Yeah, this is going to be meaningful. I mean, if we compare an incumbent in Spain versus an incumbent in the UK, for example, there's a fivefold difference in the headcount. Some incumbents have moved much faster, for example, in Spain, to reduce headcount, but we're starting to see that followed.
There's a fivefold difference?
Yeah, huge.
Right,
yeah, huge.
OK. So bad news for employees, but good news maybe for investors in some of these companies.
The headcount is shifting to other areas of the market, so into AI and into the overlaying services. So
where are we on a story about telcos railing at some of the service providers, the Netflixes of the world, in terms of running free riding on their infrastructure?
Yeah.
Have they managed to persuade? This would be a boost to revenues? They basically want these services to pay for some of this infrastructure.
Yeah.
Are we any closer to that? Is that meaningful? Does that need to happen?
We think that's a bit of a red herring as a concept. What the telcos are really railing against is not having the ability to make money in the past 20 years. And they're trying to highlight to regulators, governments, other authorities that they need to be able to make a return on their investment to incentivise them to invest in those networks and give you better 5G and bigger fibre. And so complaining about the Netflix's hyperscalers is really a way of saying we're not making money right now. That's already started to shift sentiment across the authorities and across regulators. As we said, the regulators have allowed for them to monetise fibre, and we think that sentiment could shift into mobile as well, potentially leading to authorities allowing mobile consolidation.
Yeah, and you talked about the role of AI in terms of the software play for these companies and cost efficiencies. Is there anything else that you're looking at in terms of how AI is being layered on top of these services in, if not this year, then in the years ahead?
Yeah, so AI is just another extreme of this data usage. It's going to drive massive usage of our networks. And 10 years ago, more usage wouldn't lead to more money for the telcos because they weren't able to monetise it because of regulation, both in fibre and in mobile. Now we've seen this deregulation. We expect operators to be able to monetise that greater usage through charging for it in fibre. We think there's a chance that that could be possible in mobile networks, and we're definitely seeing that in towercos as well. So the people that actually own the towers that support the mobile antennae, they're unregulated and they're making money from this too.
So at this point, the AI catalyst is real for these telcos?
Yeah.
Yeah, really interesting. Andrew Lee, breaking it down for us in terms of the telco space and a potential pivot moment then. TMT Group Head at Goldman Sachs Global Investment Research. Andrew, thank you. Coming up to UK politics, and Reform UK leader Nigel Farage declares his party, quote, the opposition to Labour in the latest surprising twist ahead of the upcoming election. We bring you the details. This is Bloomberg. Let's check in on the sovereign debt of France. It's been a challenging week with a sell-off pronounced, of course, on the surprise announcement from the French president that he was calling that parliamentary vote, and then what we've been seeing in terms of the alignment on the right and left of the political landscape in France. And, of course, that has led to shudders in the debt markets of France with a sell-off in OATs or OATs. Here's the spread then currently, France versus the German Bund 10-year. And that spread currently at around 70 basis points. It's about the highest level, in fact, since 2017 on that concern around the fiscal expansion, potentially, if you get a Le Pen-style prime minister in France. That remains a big if, but clearly there is a concern around the fiscal situation of France, given the politics. Here's what's happening right now. There's a modest bid for French debt right now, with yields coming in. But again, given the context that we've seen this week, it is only modest. The 10-year then currently sitting at 3.12 in France, yields down 4 basis points. Staying in France, left-leaning political parties there have sealed an alliance for the upcoming parliamentary elections. Polls suggest the bloc could become the second biggest in Parliament behind Le Pen's national rally, doing just another blow to President Macron. It's coming from the left, coming from the right. Let's get more details now with Bloomberg's Caroline Connor in terms of how things are shaping up. Caroline, what does this union then, do you think, your assessment, mean for this election as things stand?
Well, clearly this is not going to help to reassure the markets, because if you look at the program of the far left, who is part of this Popular Front alliance of the left, it includes some proposals such as lowering the retirement age to 60, such as abolishing fiscal rules, and possibly, according to Bruno Le Maire, at least an exit longer term down the road from the Eurozone. So, of course, we have to take this very carefully because we don't have yet the details of this Popular Front of the left wing, the details of the program, the policies. They are just at the moment saying they have an alliance. We saw some white smoke last night after their meetings between the socialists of Raphael Glucksmann, who got 14%, quite a good score in these European elections, being allied with the Greens, the far left, and the communists. So, of course, this could change the outcome of these elections. At the moment, the polls are showing that the National Rally would get between 200 and 270 seats in the next National Assembly. That's just short of a majority. And this union of the left would be the second bloc in the National Assembly. So clearly, the only alternative for Emmanuel Macron, if he doesn't want to end up with a far-right prime minister in the name of Jordan Bardella. But now, if you look at Bruno Le Maire, the current French finance minister, he's mentioning just now, this morning on the radio, that the program of the far left would also mean an economic collapse of France. So it's hard to tell what the market reaction is going to be over the next 3 weeks. If this becomes a battle between the far left and the far right, we heard from Marine Le Pen just now speaking in the north of France, saying that she promises a government of national union, because this is becoming, according to her, a fight against the radical far left.
Really fascinating on how things are shaping up there politically for France. You've got echoes of Project Fear, it seems, in terms of there's lots of echoes with what's happening in the UK, but Project Fear is the line that's being taken by the party of Macron. It didn't play so well for the Reform Party, or at least the Remain group here in the UK leading up to Brexit. We'll see if it adjusts things on the ground in France. Caroline Conrad, thank you very much indeed. And we will go to the UK right now because Reform UK leader Nigel Farage has declared his party the opposition to Labour. That's after an opinion poll showed it had overtaken the Conservatives for the first time. Just one poll, but nonetheless striking fear, you would imagine, into the hearts of many of those Tory candidates. Meanwhile, after unveiling the Labour Party manifesto, opposition leader Keir Starmer, who tops the polls, had this to say on the question of taxes.
So let me spell it out. We will not raise income tax. We will not raise national insurance. We will not raise VAT. That is a manifesto commitment. There may be some people here today who say, where's the surprise? Where's the rabbit out of the hat? To which I say, if you want politics as pantomime, I hear Clapton is nice this time of year.
OK, joining us now for more is Bloomberg's Adam Blenford. Adam, we have both manifestos then from the two main parties, Labour and the Conservatives. Where does that leave us, and what was the appeal coming through from Labour to voters at this point?
The appeal coming through from Labour to voters was really along the lines of, you can trust us, we're going to be sensible, we're not going to play fast and loose with your finances and by implication with the country. Starmer was making at great pains yesterday to try and stress that his party's project would be a long-term, multi-year effort to try and re-engineer and fix the UK, which has had some difficult times of late. But there were very few specifics on exactly how that might be done. And, of course, by saying very, very clearly that, you know, as you saw in the clip there, that Labour will not raise those three key taxes that are closely watched by working people and households around the country, that will tie their hands in terms of revenue-raising possibilities. You know, it's worth remembering that the UK, as Bloomberg reporters calculated before this campaign, paid something like £60 billion a year in debt interest payments alone. Labour's manifesto was setting out something in the region of £8 billion of tax-raising revenue yesterday.
Well, that's a really interesting size and scope.
So there's a lot of public services are going to remain under strain, whichever party comes into power. Which, of course, is looking like Labour.
And the former Shadow Chancellor for Labour, Ed Balls, saying on his podcast that this boxes them in, the manifesto boxes Labour in. In terms of there was a debate again last night. We're getting a lot of them in terms of some of the lead candidates. What came through from that? Where do things stand this morning, Adam?
Well, that debate happened just after the release of the poll that you mentioned there in your intro. And so, you know, really one of the headlines there was that Nigel Farage of the Reform Party, the, you know, very well-known leader of that grouping, said outright to Penny Mordaunt of the Conservatives, we are the opposition now, Reform are the opposition now. Now, of course, he's well known for making hay with these kind of moments, and he was always going to capitalise on this. But it's symbolically damaging for the Conservatives to see the idea that a vote for the Conservatives might no longer be seen as a meaningful way to cast your ballot. You know, the electoral system in this country would not favour an upsurgent party like Reform. They won't win many seats, no matter unless they get significantly higher returns. And the Conservatives will win some significant, but they could have the effect of really siphoning away Conservative voters, and that could vastly increase any potential Labour majority. So the Conservatives do have to watch out for what's happening on the Reform side, and at the moment they don't seem to have an answer to losing that support.
Yeah, the right flank just becoming ever more of a danger, it seems, for this incumbent Conservative Party. Adam, thank you very much indeed. Adam Blenford with the latest on the run-up, of course, to the UK vote, July the 4th. Talking of elections, South Africa now, let's switch focus, where the parliament there in that country is meeting despite ongoing talks on forming a new government in that nation. President Cyril Ramaphosa is seeking to be re-elected as head of the state at this sitting. According to the ANC Secretary-General, the centrist Democratic Alliance, the Inkatha Freedom Party and the smaller Patriotic Alliance have opted to join a proposed government of national unity. The ANC was forced to seek an alliance after it lost its parliamentary majority last month. Coming up, the clouds are starting to clear on a major investment in Italy's ITA AIRWAYS. Details on that next. We focus in on the airline space. This is Bloomberg. Welcome back. Now, Lufthansa is set to win the European Union's approval to buy Italy's ITA AIRWAYS. The move paves the way for Prime Minister Giorgia Meloni's government to offload a loss-making asset as she bids to improve her nation's finances. Joining us now is Bloomberg's global head of aviation, Benedict Carmel. Benny, what are the corporate then and political, because the two come together in this, implications of this deal?
Yeah, hi, Tom. You almost have to see this deal in a sort of split-screen kind of perspective. There is the corporate side, and that's Lufthansa getting this asset. And it's not a very big asset by aviation standards or any standards. You know, they're paying $325 million for initial stake, and then over time want to buy the rest. The more interesting and potentially more complex part of this deal has always been the political side. You know, this is an asset that's owned by the Italian state, and it's been a real millstone around the Italian government for a long, long time. It's bleeding money, has done so for decades. It's sort of a historically unprofitable asset, well known, the predecessor Alitalia, but nonetheless unprofitable. So really there was an incentive, as you said, for Meloni to get rid of this, and they finally seem to have come to an agreement with Lufthansa and Brussels, so that sort of triangulation has finally worked out. We're still waiting for the final contours of the deal, how they actually came to an agreement, what kind of incentives and concessions are involved. It seems like the long-haul part of the operation, sort of cross transatlantic, that was one of the sticking points. So at this point, what we have is white smoke that the deal is going through, but we're waiting for the official confirmation.
Which of the two sides, I mean, this has been long in terms of how this has unfolded. They finally got across the line. Which of the two sides made this more complicated? How did it transpire?
Well, Lufthansa always said this is an asset that we'd like to have, but we don't have to have it. I mean, Carsten Spohr, the CEO, went as far as saying, we can live without ITA, and he's probably right. But can ITA live without us? And can the Italian afford to not offload this asset? So there was a lot, you know, there was quite a lot of brinkmanship involved in this and a lot of hard bargaining. So Lufthansa always sort of said, we're willing to meet you somewhere, but you know there is a red line for us, and probably that red line came down to how much of their lucrative transatlantic collaboration that they have with United, were they willing to cede, what kind of landing slots in Rome and Milan were they willing to cede. You know, the Italian market is a complicated market. It's lucrative, but it's also very crowded. You have the low costers there with Ryanair, with EasyJet, and making money, particularly on the domestic routes, is very difficult. So there's a lot riding on Lufthansa, but they had a really tough bargaining position, and given the Italian government didn't really have an alternative, ultimately they didn't have too much wiggle room.
Benny, very quickly, the Euros kicking off in Germany, not in Berlin where you are, but in Munich. What's the mood like on the ground?
You know, the mood is actually pretty good. Germany hosted the World Cup almost 2 decades ago, and back then it was sort of the summer fairy tale, as it was came to known. Whether we have a fairy tale again now, unclear. But you know, generally the mood is quite good. People are buoyant and are looking for a good time.
Okay. Bloomberg's global head of aviation and temporary football correspondent Benny Carmel joining us in Berlin. Benny, have a great weekend watching those games. Plenty more coming up. Bloomberg Brief is ahead with Danny Berger. Stay with us. This is Bloomberg.